Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hi everyone, and welcome to another episode of the ASB Investment Podcast. To guide you through this flight across the NZ economic landscape, I'm your co-pilot, Nigel Grant, and today we'll be diving into a mid-year look at New Zealand's outlook, the recent OCR decision and forecasts, and also housing market dynamics. There's a lot of information and views out there, so to unpack it, and this is where I'm going with the aeronautical analogies, we have our Chief Air Marshal and the primary pilot, and he's also our senior economist and friend of the show. It's Chris Tennent-Brown with us today. Welcome back, Chris. How are you?
Good, thanks. If anything, I'd have to say I'm pretty cold.
Are you?
Yeah, it's been quite cold. I've been up in America for 3 or 4 weeks, and it was really hot there. I was up looking after my dad in the Midwest of America, and so sort of went from 35-degree days up there to coming back to sub-10 degree days.
What state were you in?
Illinois, around Chicago,
yeah,
Indiana,
right.
and Michigan.
I guess I was just going to, because you're saying you're a bit cold, but can you tell the listeners what that abomination of a T-shirt is that you've got on?
Well, I'm disappointed you didn't like it. I thought when you said I should wear it along on the show was because you really liked it. I was going to get you one. It's got 3 of my favourite things on it.
Let's do a description so people can visualise how hideous it is.
It's black. It's got a picture of a cat, which is one of my favourite things. The cat's flying a plane.
Yes. So it looks open canopy?
Yeah.
Okay.
And then Star Wars, so
Okay.
TIE fighters chasing it. So those are sort of 3 of my favourite things. I mean, I've got other favourite things.
Okay. Well, what's another favourite thing you'd get?
Well, I couldn't get barbecue, Sinai, and beer into it.
Yeah.
So I thought it'd be a bit too busy then, so I might get another T-shirt of me barbecuing.
Is there anything on the back? Is there any space you could put an adjacent image on the back?
Yeah, I guess I could do that on the back. It's a good idea.
All right, well, that's a good scene set. But we've got CTB in today to explore some of the key things that have happened recently on the local front. OCR decisions, recent and future housing trends, the key macroeconomic signals are. So if you can return your tray tables to upright and strap yourselves in, CTB is going to start cooking, and we'll get into it. We'll start with the Reserve Bank decision the other day to cut the OCR again. A few questions pop to mind that listeners, I'm sure, will be eager to hear about. CTB, what's kind of the main thing behind that decision and some of the, expand on some of the key messages you were hearing them say?
Well, I think that the thing which is maybe a little bit confusing is over the last few months, we've gone from thinking, are we at the end of the cycle? And then we had the pause, and now we've started again, and the Reserve Bank's hinting, well, there could be a bit more work to do. And for us, we've gone from thinking the OCR might stay to thinking there is more work to do. And the thing which has happened over that period is, firstly, we're definitely towards the end of the easing cycle. So when to stop and pause, assess, watch, worry and wait, as central bankers say, is always tricky. You only ever know in hindsight whether you've got rates low enough or they need to be a bit lower. But the other thing that's going on is this trade-off between sticky inflation that's higher than what the Reserve Bank would like and perhaps a bit more persistent, but also some ongoing weak signals from the economy itself. And this isn't unique to New Zealand. And the Fed's been pausing for a long time while they worry about inflation.
And tariffs and things.
And all of those dynamics. But now they've got this similar situation where they're perhaps going to need to look through the inflation concerns and focus on a couple of very weak months of labour market data in their case. And a similar story here where inflation's probably not peaked yet, but certainly the unemployment rate's ticking up.
So what do you think was the kind of, you talked about how we thought we were at the end of the beginning of the end, or the end, or whatever we call it. But what was the catalyst for kind of restarting cuts?
Yeah, I think the bit which I look back on is really that trade-off that you have to make to go, do you really think inflation's contained? Or do you want to wait a couple more meetings to assess whether that's actually the case? Or do you really want to worry about the fact that the economy is pretty sluggish and it's looking like it needs a bit more help in the form of lower interest rates? And that has won out, really. And that's what you see when you look at the dialogue, look at the commentary, look at the forecasts. You can see that the Reserve Bank is forecasting that this inflation peak that we're seeing at the moment, they're expecting it to pass, and likewise for the labour market to remain or have plenty of capacity in it to be a more important focus for them, is to worry about that.
So basically, is it correct that they are wanting to stimulate things now?
Yeah, and so back to that, do you stop at 3% and that's it? We have this magical idea of what's a neutral cash rate, which again, you only know in hindsight.
Yeah,
and we could probably find someone that would want to argue it's lower than it is now, and would find someone that could say neutral's higher than now. But when you look at how the economy's going, it appears that there's still more work to do if you wanted to make the economy stimulated by lower interest rates. The other thing which is going on, which is a little bit different to a lot of other sluggish periods for the economy or downturns, is normally at these sorts of periods we've got used to the Reserve Bank trying to improve things through lower interest rates and the government trying to improve things through targeted spending.
So like fiscal and monetary.
Yeah, that's right. So fiscal from the government side and monetary from the central banks. But now we've got the government that's part of the slowing as they try and rein in expenditure, rather than turning the taps on like we saw in COVID and the global financial crisis, etc. I mean, monetary policy and fiscal policy working together is very stimulatory, but we've got a slightly different dynamic at the moment, as the government's trying to do one thing, and the Reserve Bank essentially has got to do the heavy lifting now to try and pick things up.
And so in terms of inflation, I guess that dreaded I word, what are the key trends that you and the team at ASB are seeing, that are maybe, either shaping or have shaped the Reserve Bank's thinking, or that maybe they're not, they're missing, or is anything underlying that they're not seeing?
I don't think there's anything that anyone's missing. But again, we'll only know in hindsight whether this is transitory, the word we tend to use with talking about the persistence of inflation, or not. Remember when inflation really got out of check in the pandemic, we talked about it being transitory. Turned out that it wasn't. So you're always going to be nervous as a central banker at times like this. So I think there's nothing that anyone's missing, but there's just a bunch of stuff that you have to wait. And the classic economics line is, when the facts change, I change my mind.
That's right.
That, I think, is happening all around the world as central bankers look at inflation on the one hand and some weak labour market outcomes on the other, and then balance them off. I mean, I'm always scared to use stagflation.
Yeah, I was just going to say.
But that's a hard thing for central bankers to manage, when on the one hand you want to stimulate the economy, but on the other hand you don't want to spool up inflation by overheating things sometime down the track.
And it is just a final question on inflation, but is 3% the new 2? Is like 50 the new 40?
Yeah.
Is 3% the new 2?
Yeah. No, I don't think it is. I think a really, really important thing for central banks is to maintain credibility about fighting inflation. It's self-fulfilling. If you believe that that's what you're going to do and you believe in the central bank, that helps anchor those expectations. Where if you went, 3%'s all right, well, then people will think, well, I need to behave accordingly.
Yeah.
I think we can see a little bit of this in the States with the independence of the central bank getting fairly tested by Trump's comments and the developments there. The risky bit for that is, if you think about who likes inflation, people with a lot of debt. So who's got a lot of debt? Governments.
Yeah.
And that's one of the pillars of having an independent central bank that's job is to maintain price stability.
Yes, and not worry about
the
underlying stakeholders' debt.
Yeah, that's right. And to tie it all together, that's why I think it's very important that central banks are crystal clear about their inflation goal. So in our case, we've got a range,
Yes.
but with a focus on that 2% midpoint. Not anywhere in the range will do.
Yeah.
And they're independent and stick to that. And, here one of the things we've had over the years is debates about, well, should they have employment targets and other targets? Overall, they want the economy to be stable, but if it's inflation that they're focused on and people think it's well anchored, that actually does self-fulfill itself to a certain extent.
And I know it's sort of through the that COVID pandemic period, it's probably fallen out of the financial memory now, but I know that it was, when you're getting 6, 7, 8%, high inflation really hurts.
Oh, absolutely. And hey, look, in that period, we were getting it from both sides. We had a lot of domestic inflation pressure that was running too hot, but we also had a lot of pressure coming through from the tradable sector. So the things we import were getting more expensive. Now, if I said inflation's 2.7% right now, a lot of households would go, that's nonsense. Because we tend to form our thoughts about what inflation is on the things we buy regularly and that we can see the prices changing on. Now, that's why there's such a focus on food prices, and food price inflation is not 2.7%, it's much higher than that. Officially it's about 5%. But gee, look how expensive things like meat have got lately. The dairy and the cost of a block of cheese or a pound of butter often comes up, but mince is in there. Cheese on toast used to be my diet at university. Now that's a luxury item.
It's a luxury item for you now.
Oh, well, cheese is so expensive, but
toast.
But mince on toast is getting pretty expensive as well.
Right, just go to toast.
Yep.
No butter.
Yep.
I guess, we look at inflation there. We also think inflation can apply to house prices as well. There's a lot of talk in the last week or so around the benefits and negatives of trying to get a housing market, growing a bit faster than it is. Personally, for me, I kind of think there's a Goldilocks zone, right? You sort of want house prices to be growing a little bit, but not so it's unobtainable for anyone, because it's kind of a wealth effect, that people can sort of, helps with mobility in and out of dwellings. So I guess, I skew to that side of the argument. But what's driving the softness in the housing market, do you think?
I guess I'd wind it back a little bit. I find it a bit tragic that we think, let's stimulate the housing market and that will help
solve all our problems.
Better.
Will that bring the price of butter down?
No, it won't. And it certainly doesn't help all the people that are trying to get into the housing market to have another cycle. I think there's some interesting dynamics in there about why is the housing market not going better? Because the lead into the next housing market cycle is usually lower interest rates.
Yes.
Especially when they fall by as much as they have done. The boom in COVID was pretty extreme.
Abnormal.
And I think it's taking a long time to get over that. But if you drew a straight line from 2010 to where prices are now, you're still going to see house prices are going up.
Sure, yeah. But the hangover is taking a lot of blue power rate to fix.
But the other bits in there that are interesting, we've seen a big swing round in migration flows. So, and this again ties in with COVID. With all that pent-up demand to buy anything that we could get beyond the supermarket, we went a bit nuts in the shop.
Yep.
When we're here for a long time, the housing market had a pretty decent boom over that period, helped by low interest rates. And migration, I think, is still working through that process. With when borders opened up, there was a surge of people wanting to do what they would have liked to have done in the previous 2 or 3 years.
OEs or move home.
Or come here and study, or come here and live. But with the economy being fairly sluggish, the drop-off in migration is not helping, and they sort of fit in together, a bit chicken and the egg in some ways. To go from north of 100,000 population increase per year, courtesy of cross-border flows. So this is what Kiwis are doing in terms of coming and going, and what people that are moving to New Zealand for the first time are doing in terms of coming and going. But if you're looking at around 120,000, and we think about the usual rate of home formation compared to 2.5 year lows, where we're talking about something in the 10 to 20,000 range.
The letters now.
Yeah. So you've got thousands of houses less than you need, and compared to when things are booming along. Now, this gets pretty tough if net migration flows go negative. But things like that start to feed into rental demand over quite a short space of time. When we think about migration flows swinging around so much over 2 years, that doesn't help. The global uncertainty and labour market uncertainty, I think, really impacts people's appetite for taking on risk and debt. And so those factors, I think, contribute to people wanting to sit on the sidelines. I'm not saying this is what's going on in every case, but Kiwis do seem to have a habit of just wanting to watch and wait. We have somewhat adaptive expectations on some things. So when the Reserve Bank's cutting rates, we think, rates are going to keep going down. When housing market's going sideways, we think, maybe it's going to keep going sideways for a while longer. So I'll just wait. And now we're in winter, which is a quiet time anyway. I think the interesting bit will be how things start to go in the busier spring, summer months and then through into next year. But it's certainly a lot more sluggish than what you'd think based on the usual drivers.
And so in a nutshell, I guess what you're describing there, is that being reflected in what the REIN's, Real Estate Institute of New Zealand's data is saying?
Yeah, absolutely. I mean, it's quite volatile month by month, but essentially prices have been going sideways in most areas since last year. The annual figures are flat, and some of the areas that are really sluggish, Auckland and Wellington, also had some of the biggest price movements in a positive direction a few years back. So we're just seeing that ongoing flatlining of prices is what I think is going on at the moment generally. And the other dynamic that's in there that's not changing is that the ratio of the total amount of inventory that's available versus the total amount of sales is a very weak signal at the moment. It's a buyer's market, in other words, when there's plenty of houses that are available and not that many people competing for them.
And you talk about, I guess that's from a entering to the market, whether you're not a homeowner yet. But in our last chat, we talked about that coming wave of refinancing, right? A bit of a refinancing bubble, and that someone could have all of their mortgage debt coming up or a part of, and I guess this could also apply to people that need to refinance business lending on the side as well. Is that having an effect? And if not, I guess what's the update on kind of that refinancing bubble this year?
Economists are always nervous about using the word bubble, but wave of refinancing. Okay. Look, I think that was a factor in the transmission of monetary policy through to the economy. There was an awful lot of people that were on higher mortgages, and they're trying to time their strategies, and they ended up in the expensive part of the borrowing curve, really on floating or very shorter term mortgages, trying to tap into low rates over the course of this year. But most people over 2025 will have been able to refinance into
at least a portion, if not all,
a lower rate, and there'll be more of that going on through next year. My comment there is the time is now to at least have a strategy if you haven't got one already. And it seems too cute, and we never like picking the tightening cycle, but markets won't wait for the RBNZ to actually start hiking rates before they start pricing in that. And that's why we're not seeing very much movement in, say, something like a 5-year mortgage. The action's all really down around the 6-month, 1 year and the floating rates. And that's probably going to continue over the course of the rest of this year.
Is it correct that where rates go is primarily driven by an OCR decision, but it's not entirely? So if something else exogenous happened, it's likely to flow through and disrupt your lack of a plan if you don't have one.
Yeah, well, I think, the OCR is a key rate, but it's not where we fund our mortgages. It just influences the markets that we fund in.
The overnight cash rate.
Yeah, and at the other end of the scale, when we think about 5-year funding, that's about as long as people fix a mortgage for.
In New Zealand, yeah.
Yeah, but the global developments are key for that, and longer term expectations on things like where inflation settles, where the official cash rate will settle, influence those longer term rates. And in New Zealand's case, that hasn't been changing too much. And neither have the mortgage rates. So the sort of longer term view from our perspective that 3% is about right for an official cash rate. Longer term mortgages will be somewhere between 5 and 6% over the longer term. That hasn't changed. If I look at my 5-year ahead mortgage forecast, it's there in those numbers that I produce.
And do you think this the refinancing wave, as you call it, is there some people who are still yet to refinance and are still managing inflated or higher interest rates Is that a benefit that's still able to flow through to the NZ sluggish economy?
Yeah, I think there's a couple of bits to that. Yes, there will be still people that are working on this now, and that's why I think if you haven't thought about it already, you really need to have a strategy. But I also think it's really important that people have a strategy to try and lower their borrowing costs over the life of the mortgage.
Yes.
So it's not always just about fishing around in the cheapest part of the curve. You've got to balance up your need for certainty over the next few years, flexibility. So things people can come and talk to us about or a broker about is splitting your loan over various terms, the pros and cons of some of those longer term rates that aren't moving too much.
And also how those decisions fit into your other key things in your life. Like a podcast we've done with Nari before, right? You know, your relationship and your other pursuits. It's not all about, it should all work in harmony.
Oh, yeah. And that was a good podcast, by the way. I really enjoyed listening to it. And I kind of wished I was still 40, but yeah, there's a lot of stuff that rung true there. And I think when it comes to mortgages, the bit that you can do, which is really gold, is just get some certainty in your life. And
move on with your life.
And know your numbers, know when your stress points are going to be, and try and plan your mortgage to work in with that as well.
Yeah. And I guess also if you're at a beach, you don't want to have one massive wave you have to deal with.
Absolutely. And that's where things like having 2 or 3 terms for your mortgage can be really helpful.
Yeah. Laddering, right?
Yep.
For getting to kind of the final sections now, but looking at, you know, if you're a business owner or investor, we've talked about kind of that, you know, if you're on the debit side, you know, looking at, if you're looking to put capital to work, either through, you know, either it could be a personal investment or if you're a business owner and looking where to allocate things to, do you think, you know, is now a good time to invest or expand a business where we are currently? Or I mean, you may not know the answer, I might have a view, but
people love it when an economist says, well, it just depends. I mean, that's such a helpful comment, right?
Very.
But there is so much uncertainty in some parts of the economy. I get why within, say, a business outlook survey, you see own activity expectations picking up, which is good to see.
Yes.
But employment and investment intentions not keeping pace like you might expect, which again, it's positive to see the outlook improving.
Yeah.
But in some ways, when you're at the bottom of a hole looking up, you really are hoping that next year looks better.
So why the delta between the two?
So, I think a lot of this depends on where you're at and your need for flexibility for your business.
Yes.
And an understandable degree of caution about some of the moving parts that we just don't know yet. Probably at the good end of the scale is something like the dairy sector, which has had a lot of uncertainty over the years, but milk prices are good.
Through it.
The Fonterra is moving towards the end of its process of selling its brands. I mean, they've got a deal that still needs to be approved, but the cash flow outlook looks good for dairy farmers for the next year or two. And with good prices, you want to capture those. Great time to use the decent incomes from last year and hopefully next year to make a bunch of improvements to try and improve the productivity and resilience of your farm. On the other extreme of things, you've got sectors, and if we stuck with the rural thing like meat, America's our biggest trading partner for export destination for meat. Now, there's an awful lot of uncertainty in that area. We've got a higher tariff rate than Australia, for example. That's going to feed into things. There's other countries that have got even higher tariff rates than us that their meat might be looking for new homes in other areas that we export to. And there's all sorts of flavours in between of how some of these geopolitical issues stemming from the States could impact various sectors. So I think the businesses' focus is on sort of future-proofing themselves to deal with that sort of stuff. Is really, really important. And so I get why, even though I'd love to always be talking about productivity improvements, investing, I get why there's also a thing where if firms go, well, hey, we're hoping for the best, and if we're busy, we'll try and employ some more people rather than now's a great time to borrow a ton of money.
So to use the example of what's on your T-shirt, is the cat pilot kind of, for the average customer business out there, wants to go flying, but still a bit cautious.
That's it. Well, yeah, that's
I mean, you can use that going forward if you want.
Thanks for that. I didn't know how we'd tie in my T-shirt to business advice.
I'll just go for it.
But no, I think there's understandable reasons why there's still a degree of caution. But things have got better in terms of some of the indicators we get out of the business surveys for the year ahead. But it all fits in with many speeds, be it you're looking at sectors or parts of the economy. So there's going to be some real sluggish areas that are really challenging, and other regions which are the green shoots, as we've said in the past.
So to wrap up, before we get to kind of favourites and what you're going to recommend, I just want to focus on a question that I've only just come to sort of today after talking to a couple of key people within ASB. They're fielding a lot of questions from customers who favour and rely on term deposits.
Yep.
We know it's not just all about the debt side and mortgage and things. A lot of people need TDs to provide their paycheck. With what's happening with rates and influencing there, that's a downstream effect. So, we don't do advice, obviously, but I guess what's on your mind in terms of, where TDs are going, and also what counsel maybe you'd give to people, similar to the mortgage plan. Is there an equivalent one for TDs?
Oh, I'm really glad you mentioned it, because it's easy for us to focus on the positives of mortgage rates coming down. But hand in hand with that is the balancing act we have to play to say, how do we balance a return on a term deposit, funding in wholesale markets to build that side of our book? And there's 2 or 3 important things going on. One is, just like with mortgages, I think we're near the end of the cycle. I'm not expecting anywhere near the scale of movements over the next 12 months to what we've seen in the past 12 months.
For TDs as well.
For TDs and for mortgages. Yep. But that tying it back in with those inflation comments, every little bit counts in a term deposit. And again, if the Reserve Bank does their job and gets inflation back down to 2%, and you're getting somewhere north of that after tax from your term deposit, well, that's good. But if inflation bubbles along at 3% or thereabouts for a while,
you're underwater.
Yeah, your term deposit's going nowhere in real terms, as we say. Just like the mortgages, the time's now for having a strategy. I don't think returns on term deposits are going to improve.
But they're also potentially conversely not declining.
No, they shouldn't decline much more, but they're not going to get back to the 4 to 5% anytime soon. Unless we get into a tightening cycle much quicker than what we're expecting, and it's much more aggressive than what we're expecting.
Yeah, and that's probably because inflation's got away from us.
Exactly. Yeah. So keeping an eye on that's important. And term deposits absolutely have a space for so many people. They need the certainty. They need the regular income from having TDs maturing, term deposits maturing. But for people with the longer term plans, I think it's worth getting some advice to make sure that term deposit is the right place for you, because you do want to inflation proof what you're up to if you're thinking about 5, 10, 15-year plans. And there's all sorts of other things that you can be doing that might have some aspects that are handy.
And I guess, no one, a person in that situation, nobody expects anyone to go from a meat eater to a vegetarian overnight. It could be like TDs have a place, but as part of a diversified option, you should have a conversation to see, well, I still want TDs, but what else is out there that can help me serve that long-term purpose? Oh,
absolutely, and that's such an important thing to think about. You don't have to do one or the other.
No, it's not binary.
It's the same conversation with people that like having a rental property. Well, it doesn't mean you have to sell all those rental properties to
become a stock market investor.
Yeah, and that's where just getting some good advice and doing a stock take can be really helpful. But particularly at times like now, where people really are noticing that their term deposits as they mature are just for a year now been rolling into progressively lower rates.
The time for reset and forget maybe isn't for now. So I could go on for hours with you, as you know, and giving you a bit of grief over your T-shirt. But if we look at the kind of key messages I take away from today's chat, it's possible the RBNZ will move lower. Possible, but not much more. You can correct any of these if I get them wrong. Inflation is easing, things are soft, but rate cuts probably haven't fed through totally yet. The beloved housing market, sluggish, some areas going okay, but buyer's market, and we have this, I guess the last kind of 2 key things, there is a wave of refinancing still to do. And you need to have a plan for that. And that plan, though, should also be not just for debt, but for TDs.
If I was to sum it up, well, our official forecast is that we expect the Reserve Bank to cut twice more this year.
Yep.
So we are expecting the cash rate to go down to 2.5%.
Yep.
But we don't expect that all of that will flow through to lower term deposit rates and lower mortgage rates blow for blow.
Yes.
But the time is to have a strategy to work in how to fit that in with what you're doing if you've got a mortgage that's maturing, and get a view on where the risks lie for the longer term outlook when you're starting to consider how long should I fix my term deposit or my mortgage rate for.
And to your point, you don't have to make that decision yourself. Talk to an expert.
Yeah, and likewise, get on our website. I'll write a report about both of these sides of the book.
Well, if you don't subscribe to that report, there's one action for you from out of this podcast. Right, to our final question now.
Well, I was going to say there's one other important thing.
Please override the final question.
I'm going to have to change what I was going to get you for Christmas. I was going to get you one of these T-shirts, and I'll have to get you something else now.
I mean, if you get me one, I'll wear it.
Okay,
that's a challenge. And then I'll wear it on the podcast for people to see.
Excellent.
What's the one thing you've been reading, listening to, or watching that you could recommend this time to listeners?
Well, I've been reading a lot of the Economist magazine, as you can imagine, and I've found that's a good place for me just to go, right, I've got my latest update on all these complex things that are going on in the world. Now I can get on with it and start doing my job. So I love reading that. What I've been listening to, Pink Floyd.
Have you?
Yep.
Okay. Whilst in the air?
No.
Learning to fly? Are you literally
learning to fly? I've learned to fly.
Yeah.
No, I went to another one of my favourites, one of these come together tribute concerts.
Oh yes,
to Pink Floyd.
Yep.
That was just awesome, and it tends to lead to a build up for a week beforehand, making sure I know all the songs, so I don't screech out the wrong words halfway through and get it wrong, and then lots of listening afterwards as I remember how cool some of these old tunes were. So that's been what I've been listening to.
Cool.
And I listened to your podcast with Nari.
Oh, thanks. Well, my recommendation was actually, it's very self-indulgent, isn't it? I was going to shout out you talking at the Karen Walker event that we hosted the other night.
Oh, that was good fun.
Yeah, so for listeners' context, we hosted a number of clients down at the Britomart in Auckland's Karen Walker boutique there. We're very lucky that Mrs. Walker hosted us there. CTV was on the panel, and we talked about women and wealth. So we obviously had the Chantel Giles podcast go live. We built on that, and it was just a fabulous conversation, wasn't it?
Yeah. Yep. And I got a lot of advice from my mum and my grandmas.
Yes.
So I wish that one of the females in our team could have been on the stage instead of me. But two were on maternity leave, and one was at home with a kid that had just burnt its hand.
Yeah.
And so they had to take me. But it was a pleasure to be there.
And I just want to do, I guess, to that effect, a plug for, we're doing more events like that around the country in October and November as well, all across the region. So if you are a client of ASB and you're very keen to be at one of those, you can probably reach out to your ASB wealth manager and just see if you can come along. We'll just tease that out there a little bit. You're going, eh?
Yeah, I'm going to put a suit on. I won't wear this T-shirt.
Well, I mean, put it under the suit.
Yeah, there you go.
Yeah, we can just, we can leave it there for a special occasion. As always, CTB, thank you for giving up your precious time. It's a pleasure having you, to discuss all things going on. We'll get you back again soon.
Excellent.
And when are you next in the skies above?
Well, I'll definitely be in the sky on Friday because I'm flying down to see my brother in Nelson. But that'll be courtesy of Air New Zealand.
Okay.
But I'm hoping I can go for a quick fly in the morning and some cool old plane on my way out to the airport.
Do they get you the hat and the lollies out?
Oh, when I was a kid, I did, but they've told me that I have to get out of the way and leave it to a 10-year-old, not a 55-year-old.
Well, as an air marshal, I thought you might have been given that right. That's all for today. So until next time, I hope you enjoyed the episode. Happy investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.